My opinion is I'm pretty bearish, and you have all the things that drive markets are going the wrong way on you. So you have credit spreads rising, high yield spreads are up 80 basis points in year to date. You have volatility elevated, but not elevated enough that you create the bid. You have the dollar rising, so the dollar wrecking ball work against you, and then you have oil, which is the primary energy commodity of the world, rising at an incredible clip. That squeezes people. And then yesterday, you basically had the market realize Jay Powell might not go anywhere, and you could have interest rates staying where they are. And look, so everyone knows, I'm long the SFRZ7s, which is December 27 SOFRs. Well, I've gotten my ass handed to me in the last 2 weeks as we've taken 2.5 cuts out. So now you have interest rates going wrong. All 5 things that are the most important things are going the wrong way on you. I think that's a lot for the S&P shoulders to handle. So
I wouldn't underestimate the Jerome Powell thing to the markets, because what it shows is that it's just like whenever they bring up the idea that the president won't step down at the time of a new election, even though it sounds crazy, the idea of an orderly transition of anything, let alone the Fed chair, that gives people like that idea of like, we're orderly, we follow rules, and the rest. So this sounds like, if you didn't think he was political, you now know, okay, this is political. Maybe he has legal advice, but it's clearly not a, hey, let's have orderly transition. Now, I'm going to say, I want to hear what you guys think of this. If I had $100,000 and I'm kind of newish to the market, would I be investing today, or would I try to wait for things to play out? My personal view would be, no, this is a great time to average in. Maybe a fifth of it, maybe not all in, because it doesn't feel like, to me, that this is the worst of the worst. But overall, the U.S. is in great shape. It's not in great shape. It's in very good shape. Employment is high. Production is high. Things seem to be going okay. This is, I would say, a good time, if I were starting to invest, to put in some money. What do you think?
You want me to go?
Either one. There's only
three of us. To be perhaps redundant, what I do is I go through every ETF out there and I find the 10 best. And after going through that last month, I would be, in this example, I'm 23% in cash, because I took some money off the top of platinum, copper, and silver, and I'm really glad I did. The only thing I want to do today is short the financials. SEF is the ETF I'm looking at. I'm this close to pulling the trigger. My main problem in the past, this basically shorts the XLF financial sector in the S&P. Berkshire is 12, 13, 14% of that index, depending on the day, which is like, shorting mom and apple pie. But Berkshire's rolling over, and the Warren Buffett halo is gone. And so in your example, I would be 90% in cash and 10% short the SEF, and then waiting for new opportunities, and be cognizant of the fact that you could have some news that, we've won and oil goes down $15.
All right.
And stocks rip. I think it's very possible.
Ben, what do you think?
Yeah, I just think there's been way too much infrastructure damage. I don't think that you're going to get it to come back like that. And you can look, you're looking at WTI, but the spread between Brent and WTI is absolutely blown out. So the S&P is reflecting the reality that the U.S. is the relative winner here. Russia, Brazil, and U.S. are the only people really built to handle this situation. Japan and Europe are absolutely getting hammered. Anybody who's energy dependent, forget about just oil. You're really talking about the refined products, and that is where you're really going to see jet fuel and fertilizers, urea. And one thing that people aren't talking about enough is helium, which comes from the Middle East. There's a chance this can persist, and they'll actually have to shut down the Taiwan semiconductor situation. And that is then I'm short the SMH. I'll tell you, that would be an absolute disaster. Plus, you have the whole unknown, of what if China makes a move on Taiwan? There's just a lot going on here where I just wouldn't be cavalier at the S&P that's 26, 27 times trailing earnings. It's not like this is a deal. You know what I mean? Like, this isn't like exciting in any way, shape, or form as like, you know, if it was 10 times earnings, okay, we could talk about that. But we're talking about 27 times trailing earnings with maybe a CapEx boom that is going to sputter out and a labor market that's weak and the revisions keep going down and everything I said before. Like, yeah, I would fade that pop.